Let's talk about Schedule E income. So, income that shows up on your personal tax returns under the Schedule E. And that's typically the Schedule E rental income section, is what we're going to talk about today for real estate owned, REO. Other things can show up under the Schedule E, like maybe some royalties, oil and gas stuff. I've seen we've seen authors have money show up here for other types of royalties. That's not what we're talking about today. And oftentimes, just as a side note, if you do have those type of distributions, whether it's oil, gas, or things like that, that's a challenge to use that income. It's hard to prove that it's going to continue and be likely to continue. So just keep that as a side note. But we're going to talk about REO, rental income specifically. And I want to throw a word of caution into this. So if you don't know, well, you don't know me, so I assume you don't. You don't know this, but I owned from 2003 to 2023, basically for close to 20 years. I owned rental properties, and in doing that, I won't say victim because but I was ignorant. I didn't know better. Worked with a CPA who probably also didn't know better because I was a young early 20s guy with a CPA that was probably relatively new, and we didn't do our tax returns correctly. I see that more often than you would think. When we do loans and we see tax returns, folks are not doing reporting rental income properly. So please make sure you're working with a good CPA and you know what you're doing, because again, we'll see income show up here or maybe not here when it should show up versus an LLC. So again, just make sure you're doing it the right way. But the concept here is that the Schedule E would show if there's rental income, it shows, the whole breakdown of, the revenue minus the expenses equals the net. And in the mortgage world, how we calculate that is certainly got that net bottom line. We can do certain things as far as how we calculate the income to add certain things back. So for example, we would add the taxes and the insurance back because we're going to count those liabilities against you if we're doing a loan on that new home. So if we're refinancing that investment property, how do we come up with that rental income is going to be based on, we're going to use the real taxes and insurance when the loan closes, not the numbers showing up in the tax return. If we're doing a loan on a different property and those taxes, the taxes and the insurance show up, again, it depends on if you have an escrow account, don't have an escrow account. It's going to depend on what we do, but it's amazing how just inaccurate I see Schedule E's. Like I see really low. A lot of times I may not even see the taxes or insurance deduction. So somebody's paying more taxes than they should. So I would just say get with a good CPA. There's other things that we can add back, like paper losses, like depreciation. We can add those things back to the Schedule E if needed. But ultimately, and it depends on the loan program type. Like some loans where we don't need income, like DSCR loans, so it's debt service coverage ratios for investors. We don't even need to see tax returns. So that, this conversation is irrelevant for those folks. But the reality is, if you're doing a conventional loan or a government loan like FHA, VA, USDA, or Fannie Mae, Freddie Mac for conventional financing, they're typically going to take a 2-year look back and they're going to do their best to see if there's consistent. They'll take an average. If it's declining, then they're going to use the most recent year for the worst case scenario and probably ask a lot more questions to make sure we can do it. So I'd say ultimately do your homework and make sure that you have an accurate Schedule E, right? Give it their CPA before you push file. Make sure it's correct so that we can use the proper income you deserve and you earned on your rental properties. And again, look for, if you have a whole bunch of tax write-offs, just realize that if you show that loss, that's okay. We just got to count that negative number against you in qualifying for a, air quotes, a normal mortgage. So if you have any questions, feel free to reach out to the Mortgage Mark team. We are here to help as always, right? We're here to answer any questions you have or somebody else may have. Get a good CPA. And when you think mortgage, think Mark.